All right, I'm just gonna start again. I'm so sorry about the sound fiasco. Just get started on how to legally reduce your taxes. We talked about ANPA Foundation, benefit of ANPA membership, how to connect with ANPA, talked about the webinar, and the disclaimer was read. And these are our presenters. We're going to introduce Amy first. And we don't have sounds for this, unfortunately, guys.
Now we hear the sound.
Okay.
We hear it.
He's cheating, don't worry. Kids and grandkids. Family.
Yeah.
What's our granddog?
What do you say?
No, I'm just talking. I said I wanted to introduce our granddog and the family.
Oh, okay, okay.
For those of you who don't know, I'm a wannabe comedian and a bad joker at it.
All right, this is Annie. Annie, you will then introduce our speakers. Annie, are you ready?
I am as ready as I can be, my friend.
Okay, go from there. You can take it from here.
Good morning, good afternoon, everyone. Thank you again, Stanley, for orchestrating, what is it? Did you say 26, 27, 21?
This is 26 ANPA webinar since 2020.
Yeah, for the last 3 years, we've been doing this, and hopefully it's been beneficial to everyone. And what we basically are looking to accomplish is get you educated by specialists. You know, our tagline is talk to us, expertise matters. So we bring you, like Stanley said in the presentation, solutions and strategies from people who are true specialists. They're an inch wide in focus and a mile deep in expertise. So Charles Wapara and George are two of the members of our ecosystem, our virtual family office, that we're introducing to you. I think you guys have experienced a number of them through the years. They're going to talk about tax reduction and risk reduction and expense reduction. And then I will talk about the other, how to use those things to grow and leave a legacy. Charles, are you here? Charles, can you hear me? I know he was.
Yes, I can. I hear you. I was on mute. Sorry.
Excuse me.
Charles, can you show your face if possible?
Yes, I can. 1 second.
Thank you.
Charles is the founder of New Era Tax Services, He offers proactive tax planning and preparation. He has extensive and invaluable is really the word, experience in tax matters. He is an IRS registered professional. I kind of wanted to abbreviate this guy. I'll tell you what, I tease him that I am going to take out a key person insurance on him. So you can appreciate. He's going to be brief because he's got another commitment. He's going to talk on three things here. But when I say I will take out a key person policy on somebody, I'm sure those of you who understand that concept know what that means. Charles is going to address three things because, again, he's got some other things. He's got another thing on his agenda today. So, Charles, let me turn it over to you, my friend.
Good morning and good afternoon. And
Go on to the next slide, Stanley.
The reason why I'm saying good morning and good afternoon, I'm in the Central Standard Time, and we're still in the morning. And for those of you in the Eastern Standard Time, and that's why I say good afternoon. So it's a pleasure being a spokesperson in this webinar, and really thank Mr. Enyekano for inviting me into this discussion. First of all, I'll give a little background of myself. I'm a tax practitioner. I've been doing taxes for over 30 years. I've been in Louisiana in all 30 years. And I also not only, I'm a retired state employee. I work for the state for 30 years as well. And when I mean state, I'm talking about the state of Louisiana when it comes to healthcare. So anyway, to get to the point at hand, and the point at hand meaning, what do you do or how do you start a business? Most of you in the medical practice should know, because if you're, most of you are sole practice, and if you're not sole practice, you're working for your interest represented, is the group interest represented. And if you're working, you'll find out a familiar story with most medical doctors. And what is that familiar story? You work and pay everybody's salary and pay for everything for them. But at the end, you find out you're barely paying your bills and you're barely investing in yourself. And then you pay those large taxes. At the end of the day, Uncle Sam gets his part, the employees get their part, and you come out with nothing, but you did all the work. So the point we'll be looking at today is how do we help you save that money, make those sacrifices, and make sure that you invest in yourself other than paying Uncle Sam. As Mr. Enyi remind me, he's not your relative. So now let's look at how do you pick up if you want to start a business or in the process of starting a business, how do you pick up the right entity?
Come.
I'm sorry?
Go ahead, Charles.
Okay, how do you pick up the right entity? Well, I mean, I want to start a business. I'm looking at starting a business. What do I pick? How do I pick? What is it exactly that I'm looking at? You have to look at what do you need? What do you intend to accomplish? And then all of that will manifest into picking the right entity if you know what you want. And one of the mistakes we make is that we immediately run into a computer and we go to irs.gov and we fill out those SS4. And then when we fill out those SS4, we get a tax ID number. And we don't even have time to read what is on that letter they sent to you. And that letter is a CP575B, and to some degree, CP575A. Very rarely do we read what is in it. We just looked at it, I got a tax ID number. Wow, I'm ready to do business. But IRS look at it in so many ways. And what are those ways? When you go online and register those entities, the first thing you ask you, what type of corporation are you going to be? And the first thing that comes to our mind is what? LLC. LLC. I'm going to get an LLC. And so many of us, most of us haven't even read what are the laws in the state that you do domicile, the state that you're domiciled in. What is the laws relative to LLC? What exactly does it do? And many always misconstrue the fact that LLC is not a tax instrument, it is a legal instrument. Legal instrument is a limited liability corporation, nothing to do with taxes. But again, once we pick up that LLC, what do? We said, okay, the first question IRS will ask you if you call them on the 800 number. Are you a single member LLC? Are you a multi-member LLC? The question when they ask you that single member or multi-member LLC is to determine, since you are telling them you're an LLC and they have no clue what you want. So single member, they would default you to a sole proprietor. Multi-member, they would default you to a partnership. Now, is that what you want? The question may be no. Why so? Because for a sole proprietor, that income that you make is going to be under your social security number, even though you do have a tax ID. And that income will be reported on a Schedule C, and it'll be part of your personal tax return. Is that exactly what you want? And again, based on that income, you'll be paying self-employment tax on that income after deductions. So again, picking the right entity is very important, is very instrumental in being successful in your business. So before you pick those entities, before you pick those entities, just make sure that you've consulted with a professional that knows at least a little more than you do. And that will help you on the entity aspect. The second part about what we're looking at, before I summarize, before I look at the employment tax, am I paying myself? Am I taking the right deductions? Am I investing in myself? And then am I incorporating other family members into that corporation to save taxes? And then if you do those are the things that will help you reduce your tax liability. And the last part of the reason is, what is the purpose of setting up an LLC for your business, and how does it work for you? So you can look at setting up a business in the fact that when you look at your state laws, look at what the LLC stands for, and look at what you as a person wants to accomplish from your business. Is your business going to help you pay? To some degree, you create, like Mr. Kano was talking about, wealth management. You create educational policy where you offer education, training, or school or whatever, which will encompass your family members. And how do you do that? All of those things. How do you set up a retirement plan? How do you set up health benefits so that you can have health insurance without worrying about that part? Because most of the doctors take care of other people, but forget that they will need to be taken care of as well. So all of those things are the things you look at. Is my business set up the way where it will do all of this for me? And in conclusion, you look at all those three aspects of what I mentioned about setting up the business right, making the right deductions, and accomplishing what you want to do, then you have a very sound business and you will do well going forward. And you save those money instead of giving it to Uncle Sam. So in conclusion, this is how you determine if you're making progress, if you're succeeding, and all stands from how you set it up. So in wrapping up, I just want to thank you for giving me this opportunity to present this to you. And as we go on, I think I'll probably have slides and everything, and to display in the next meeting, whatever. So thank you, Mr. Kano, and thank you, everybody.
Thank you very much,
Thank you.
Charles. Appreciate your time. It looks like you're traveling. I really appreciate that. You're ready to introduce your next speaker?
Yep. Thank you very much. Go on to the next slide, my friend. George, CPA, Oluwaboro, the managing partner, Brickstone. Brickstone is financial services company, CPA. Founder, Disciples Fund Incorporated. He's got over 20 years of experience in accounting, financial management, budgeting, and has dealt a good bit in the private and public sectors. He established or was instrumental in the first African mutual fund company in the US. He was a fund manager for that fund. George, I'm going to have you go ahead and take the next 10 minutes or so to summarize and talk through your, talk to us about tax savings. You guys are dealing with the tax savings things. So your strategies, my friend.
Okay. Thank you very much, Mr. Kanu. It's nice to be here. Thank you, ANPA, for the privilege to have a conversation on tax planning with your members. This is my first time of hearing about ANPA. I couldn't believe it myself, and I've been in the US for over 30 years. Anyway, it's a great honor to be here. Briefly, I've been an accountant for over 25 years. I studied economics in Nigeria and moved over to the US. And I've worked in several organizations, including the Federal Reserve in Washington, D.C. But presently, I'm the managing partner for Brickstone and Associates. We're a boutique accounting firm. We do auditing, business planning, and all other things relating to business. Today, I would like to share with you, based on my experience in the industry and basic information that might be able to assist you, especially those in the medical field, to reduce your tax exposure. I would like to use the word exposure because no matter what, you have to pay taxes, but there are a lot of information in the tax law that if you know the right strategy, you'll be able to keep a lot of your money. And so that is the purpose of this session, for me to just talk about taxes with you. Can you go to the next slide for me? I would like to go about, maybe some of you might be aware of this, go over some basic facts regarding taxes. When I was growing up in Nigeria, we don't even talk about taxes at all. We don't, maybe because we're not working. Even if we are working, we try as much as possible. We don't even think about it. But when you move over to the US, definitely taxes are the basic stuff that as an individual or as a business person, you have to be aware of it. In this situation, taxes are unavoidable. You have to pay your taxes. The US tax law has been around for several years, for a lot of years, and so it's been evolved over time, making changes to it to make sure that it is fair. It is fair. They make it to be fair, but in the process, you have to get knowledge about taxes before you can actually take advantage of it. And also, you have to know that taxes are one of your major expenses. One of the things I want you to be aware of now is that you have to know what your tax brackets are. What you are looking at right now is just the basic tax bracket for individuals and businesses as well. We have the 10% up to 35%. The more money you make, the more taxes you pay, but there are instances where you can use the tax law to knock down your tax bracket or to reduce yourself from 35% even up to 10% if you know the right strategy to use. So you want to know the following to save money on your taxes. Basically, you have to know the difference between the standard, what is called the standard and itemized deduction. The standard deduction is just like the Uncle Sam will say, okay, you are filing your taxes, but we are giving you a chance. You can either take the standard deduction or you can itemize your deduction. There are so many variables in there. But the standard deduction gives you, if you are married and you are filing joint, you have the standard deduction for this year is 27,700. And if you are head of household, your standard deduction is about 20,800. And so if you are single, your standard deduction is 13,850. But if you decide to itemize, you have to make sure, you have to know which one is better for you. So if you itemize and you know that your deduction will be more than, let's say you are married with more than 27,700, then you might as well go for the itemized deduction. One single area you want to be aware of is if you have a home and it's a big home and you are paying interest on your mortgage, and your mortgage is about 30,000. So automatically, you know that it's better for you to itemize than taking just the standard deduction. Also, you have to take advantage of being self-employed. Mr. Wambara mentioned something about picking the right company or the right type of business that you can start for yourself, or the type of business that you can, maybe an S corporation or LLC. We won't go into that detail right now, but it's something that you have to be aware of. Also, one of the things I want to also mention is that if you refuse to pay taxes, there are a lot of penalties that are involved. It is the law. We must file our taxes and pay the taxes on a timely basis. And according to the IRS, there are the most common federal penalties are the failure to file on time, failure to pay your federal income taxes on time. There is a difference between file on time and then pay the taxes on time. Then failure to pay the correct estimated taxes, and then dishonored payment. If you write an IRS a check that was not honored, they are going to penalize you. One of the things that happen is if you do not file on time, they will penalize you back to the time that the tax is due. If you don't file your 2021 tax in 2023, the IRS will penalize you and they will charge you interest from the time that the tax is due, which was supposed to be in April 15 of 2021. And so we have to be cognizant of that. So having known that, let's talk about the tax strategies that are available to you as an individual or as a business. Based on this, it is a deliberate plans and action taken by individuals and businesses through the tax laws and regulation, deduction, credit, so that you can apply those tax code to enable you to reduce your tax exposure. Effective tax laws, effective tax law that you know will help you. I'm going to go quickly over 10 major tax strategies right now. It's more than this that you can use as an individual. Number one, you can consider forming a professional corporation, just like Mr. Wabara said. You can form a corporation. When you form a corporation, you'll be able to you'll be able to legally shield yourself from paying taxes because certain expenditures will be deductible as a result of your business. Number two, you can defer your income. Let's say you're expecting a big windfall in this year, and if you know that that will enable you to be in a larger tax bracket, you might defer those income to the following year so as to reduce your tax liability. Also, number three, you can make a deductible charitable contribution. It's in the tax code. It is in the tax law. You can make contribution to charities, and then you'll be able to make those tax deductible on an ongoing basis. And that is very important when we talk about standard or itemized deduction. You can only itemize take that contribution if you itemize your taxes. you save more on retirement. This is number 4. This is very, very important. If you have an employer that offer a 401k, you should take advantage of it, because that will enable you to have some money tax deferred. You can contribute as much as, in 2023, you can contribute as much as 23,000 for your, as that you can deduct from your income, so that you don't have to pay taxes on that. And also, if you're over 60, you have what is called a cash-up contribution of another 11,200 that can be added. Also, number 5, another is home office expenses. If you are doing business from your home, or you dedicated some part of your home as an home office, that is also another way for you to be able to deduct those expenses from your business. Number 6, exemption of capital gain on sale of primary home. For example, you have a lifetime opportunity to not pay taxes if you sell any of your properties, which is if it's more than, you have about 500,000 lifetime if married, and I think it's 250 if you are single, to be able to take that deduction. Let's say you sell a home and your capital gain from selling that property is about, let's say, 200,000. You can take that 200,000 without paying any taxes on the amount. But the point is, you are now left with, let's say you are married, you are now left with 300,000 for your lifetime, before you can also take advantage of that. Number 7 is very important for those which calls Section 179 expenses, expensing and depreciation deduction. If you have a business and you are buying equipment, the IRS gives you the opportunity to deduct in first year if you spend up to $1.8 million or $0.08 million one time for your business. That will enable you to reduce your taxes for that particular year. Then qualified business income is similar to business expenses. All business related expenses is legally allowed to be deducted from your income, and it's always very advisable. I always advise my clients set up a business and be able to deduct all related reasonable business expenses from your tax return. Number 9 is setting up employee benefits plan for your employees. If you're an employer, you are allowed to set up employee benefits for your employees. You have an advantage that will enable you to keep your employees, and at the same time, all those benefit plan will be deducted as all of the 100% deductible from your business income, and so that gives you more money into your pocket. Number 10 is very, very important. I would like to stress that it's called research and development deduction and credit. I believe a lot of medical staff or medical personnel, they think they develop products or services that require some maybe coming up with setting up a lab and all that. All those expenditures relating to those setup, they are all deductible, and they are deductible in form of a credit towards your payroll taxes. And so if anybody is looking into developing the new treatment for cancer and all that, this is a very unique opportunity for them to be able to spend that money, but at the same time be able to document it. That way they will be able to, that individual will be able to deduct those expenses. And everything that we're discussing here, everything is in the tax code, is legal, and you have to get people that are knowledgeable about it to guide you and to give you their perspective. Most of the things about taxes in the US, the state, the federal, the state and the federal, they have information that is available, but sometimes is voluminous, but you have to be able to find somebody to assist you in navigating the process. The IRS.gov, the website is great. It's a great way to start. And then you have to, each state has their revenue agency that you can also look into their website. And I hope we'll be able to assist you if you need any more information on this. We'll be glad to provide that information going forward. I want to say a big thank you to ANPA and to Dr. Kanu for giving me this opportunity to introduce myself to you guys, and I look forward to answer any questions if necessary. Thank you, sir. Ama.
Thank you very much, my friend. I hope this has been helpful in at least summarizing in some measure the steps and the things that are potentially available for you from a tax saving standpoint. I am going to, Stanley, my responsibility is to convert. When you realize these savings, then it becomes our responsibility as a family office to convert those tax savings to growth assets, multi-generational wealth, legacy, and philanthropy. Before I get into this, though, I want to summarize, I want to share with you, Stanley, go on to the next slide, if you will, please. I want to share with you, you see, there were just a few solutions and strategies that were talked about today. They didn't really even touch them. Right here, and we're happy to send you, I'm happy to have my office send you this list of strategies. Now, the thing about it is, we can give you a gun, and if you don't know how to shoot, it's another thing. So again, our tagline is "Talk to us, expertise matters." So keep that in mind. This is a sampling of some of the strategies that are out there. Some of them they've talked about. Next slide, Stanley. My responsibility is to get our tax team to help you with tax reduction strategies. Some of them I just outlined in the previous slide. Our tax team does the savings. Now, that could be your accountant or whoever. It doesn't really matter to me, okay? As long as they're proactive, we can work with them in the work they do. They will provide you the savings, then our job is to convert it into wealth, legacy, philanthropy, and all that stuff. Secrets to wealth, those of you who've seen our webinars before have probably seen some of this stuff. You got to generate cash flow, become a doctor, stuff like that, minimize taxes, avoid losses, accumulate growth assets. And then, of course, you got to plan proactively. And then if you're really going to be financially free, the three letters are OWN. And I'm not talking about Oprah Winfrey Network. Work to own. So if you're getting those W-2s, own stuff. Own a business, own real estate, own life insurance. And my friends, you already started on this track. Own your destiny. Next slide, please. Taxes, taxes, taxes. The impact of taxes. I don't know how many of you know about this. But if you take $1 and double it 20 times, you end up with $1 million. Most of us on this webinar are in a tax bracket that is at least 25%, unless you have substantially proactively planned to reduce your taxes. Let me say this. You take your $1 and you double it 20 times, you got $1 million. In your tax bracket, without tax planning, if you're paying 25%, your $1, 20 doubles, you're going to end up with $72,000. If you're in the 33% tax bracket, $27,000. Now, you choose what you like. Whether you want to save taxes and be proactive, end up with $1 million, or 72 in the 25, or 27 in the 33 plus. Next slide, please. I'm going to leave it to you, my friends. I want to talk about losses because a lot of people have a misconception about performance. You get your performance from Wall Street or wherever it is. let me ask you guys this question. You're up 50% one year, you're down 50% the next year, you're up 50% one year, the third year, and you're down 50% the fourth year. What is your average return? Stanley, can anybody answer that? Zero. Interesting, isn't it? All right, go to the next slide. Now, does everybody agree with this? You know, normally I would say if you agree, say 8 or give me a number on the thing, but we don't have time. Let me tell you what the reality is, my friends, because this is exactly the problem. Your $100,000 is up 50% in the first year, so you got 150. Second year, you're down 50%. How much do you have? 75. Third year, you're up 50%. You're up 50% of 75, so you've got 112. Fourth year, you're down another 50%. Now, your average performance is correct, but your actual performance is wrong, is what the real thing is. Your average is 0, as Stanley said. Your real performance is you lost almost 50% of your money. These are things that people don't know and don't pay attention to. So they come and tell you all these stories, and your investment returns are not telling you what the reality is. Go on to the next slide, my friend. What I'm showing here is risk return, and I didn't even get into the, what losses can do for you. One thing I will say is this, because we're really constrained for time, we want to save some and give you time to answer questions or ask questions. We have a myriad of solutions and strategies. I'll tell you this. Asset classes, look at this. I don't know how many people here really understand, life insurance as an asset class. Okay, look at what we've got here from the left to the right. Most people don't know that life insurance is a major asset that you can have in your portfolio for tax planning. You can use life insurance as a Roth IRA, a super Roth IRA. I can go on and on and on. And but a lot of times we're pivoting to those things that could have losses, because those are the things we know. Real estate, for example, is one of those assets. We call it your smart investment. You get leverage, you get appreciation, you get tax-free wealth transfer if you properly structure it. Next slide, my friend.
Life insurance.
Life insurance, we call your ultimate asset. It's the most efficient income and wealth transfer vehicle out there if you structure it properly. You get tax-free growth, tax-free income that you can use and spend, protection from losses, liquidity, my friends, and tax-free wealth transfer. Again, it must be properly structured. Life insurance is like owning real estate. Now, would you rather own A or B? If you own a 5-story building that's empty, would you rather own one that's empty or one that's fully occupied? That's the way you got to, when I say properly structured, that's what we're talking about. You need to maximum fund and properly structure your policy. So it's like a 5-story building that's fully occupied. Next slide. So here we go. Everything I've talked about has got to do with assets and things like that. One of the things that we offer at our firm is what we call the premium life. And we have a premium life 100 club. You can, whatever it is, the QR code, you can scan the QR code to learn about this and stuff like that. If you want to get your own illustration, go ahead and do that. But the premium life is about truly building multi-generational. It's really about building the premium life for yourself, building multi-generational wealth, and leaving a legacy. It's truly a Swiss Army knife for wealth and financial success and transitioning. Anybody interested, scan the code, get your own illustration. Multi-generational wealth and legacy, my friends. Same thing. Would you rather leave $250,000 for your kids, or the potential for almost $2 million over a lifetime? Now, if you would rather leave $250,000, keep doing what you're doing, that's fine. If you would want to see how to use leverage to create multi-generational wealth and legacy, talk to us. Next slide. Hey guys, philanthropy is the last thing we can convert all those savings into. Some of you who've been involved with this stuff that we've been doing know that we currently have the Diaspora Investment and Charitable Life Settlement Fund. This is the foundation, a collaboration with our firm and the foundation. We're basically targeting $10 million. This is philanthropy, my friends. So you convert all those savings and you can give to ANPA, give to your, causes that are near and dear to you. This investment opportunity is still ongoing, my friends. Okay, we're raising $10 million. The $10 million will control a policy, fund of a portfolio of life policies and things like that, from which you're going to multiply your original investment by maybe 3x or 4x or whatever it is over a less than 10 years. Next slide, if there's, my friend, if you're interested in any of that, just reach out again to us. Here's the summary, guys and girls. What we're trying to do here is say you be proactive. Focus on tax planning because you're going to realize tax savings from tax planning. Take the savings and then convert them into growth assets, multi-generational wealth, legacy, and philanthropy. Next slide, my friend. Question, Stanley, it's back to you.
Okay, thank you very much. This is a fire chat of tax savings. So I'm going to go back to taxes because this is the reason why people are here. We have over 60 people online, and I see some people have their hands up, but I want to go back to taxes. Amy and George, this is like yes and no, quick, okay? Tax break for 2023. What are doctors and people, what can we do to save money before we file our taxes this year? I'm going to give you some lists. Say yes or no.
Okay.
Not that we're promoting anything, but
understood. Go
number
ahead.
one, is it too late to start a business for
2023 or 2024?
2023?
Late.
Take
It's
advantage
late.
of it.
It's too late.
It's too late. Okay, that's fine. That's why we're here. If you already have a business, can you make some expenses in your business, invest in your business, and take advantage of it for 2023?
Yes.
Too late. Okay, so we know.
It's not too late is his answer. He says you can.
You can. I mean, you have to, for individual, you have till April 15. And for businesses, especially if you're an S corporation or partnership, yesterday was the cutoff. If you didn't file for your extension, but if you have filed for extension, you still have to September.
Yep.
To take advantage of that.
Okay.
September 15.
September 15th. Thank you. I'm so glad Charles is still here. Now, retirement, is it too late for 2023 for people who to save money on retirement and take advantage of the tax code?
It's not too late.
Okay. Why?
Not too late.
Explain a little bit.
April 15.
No, next question. It's not too late. We don't have time.
Okay.
April 15, unless you file an extension, which would take you to October 15.
Okay. Correct.
No. Is it too late to employ your wife or your children in your business and take advantage of that?
Too late.
For 2023, it's too late.
We're talking about 2023 because the reason some people have not filed their taxes today is what can they do to take advantage of stuff that they're potentially missing? Okay, it's too late for you to employ your children and your wife in your business, correct?
Yes.
Correct.
Is it too late to give donation to your, like, let's say ANPA Foundation and take advantage of it for 2023?
Yet.
No, it's maybe that's.
I need two of you to agree on something.
It depends. It depends is the answer.
It
depends. It depends.
Explain.
It's case specific, my friend.
Okay.
That's going to take time.
Okay.
Contact us and we'll basically provide you the correct answer for your case.
Is it too late to invest in your home business if you already have a home business? And I think you've already answered this, to spend money in your home business and take deduction for your home business before you file your taxes. If you have a home office.
It's too late for 23.
Okay. And real estate investments. What about 2023? Everything's 2023 because the deadline is April 15.
Remember when you asked that question that there are issues when you have fiscal year, and if you're filing individual returns, you're on what they call a cash accounting method, and cash take you from January to December 31. Now, if you're on a business, it's on a different fiscal year, then that's a whole different issue, depending on when your fiscal year runs on your corporation But again, on the individual tax return, you are basically defaulted to cash accounting method, which will be calendar year.
Okay. Those are some of the notes that I have. I'm going to open up the floor for questions. Dr. Emerewa, you have your hands up. You're driving, so I hope you can pull over. We can't hear you, Dr. Emerewa. I know you're not muted, but we can't hear you. Dr. Emerewa, can you safely pull over somewhere? Okay, I can hear you now.
Okay. Yeah, thank you very much. I think this has been very wonderful and very productive. And I think since we don't have time, tax is not something you do just on the fly. For those of you who are young, have a meeting quarterly with your accountant, with your financial people, and start talking about, okay, how much am I going to make? How much am I going to have to pay? But my question actually, and maybe we don't have time for that, is that as we're talking about cost, saving money, can these experts give us any comments on how
His question got lost. On how what?
the charges you get from your advisors? I just looked back to how much I've paid to people who are advising me. I've paid almost $500,000 in the last 40 years I've been doing this. And to me, that's money I could have been investing. One of the things I learned is that I could have actually paid after pre-tax dollars, pay them out of my business expense rather than have them take it out of my retirement money. Is there any way you could help us understand how we can save the money we pay people who are advisors? Thank you.
Structure. How did you structure yourself? At the beginning, that is what I talked about, structure. If you structured your business or whatever you have, whoever you are paying, and depending on the type of business you set up, then the business would be deducting these expenses, then there would have been a business expense. Again, the structure. How did you structure?
It was structured. I'm an S corporation. My advisors were taking the money directly from my retirement account rather than having me pay for it with after-tax, pre-tax dollars.
Then you need to talk to Mr. Kano.
Yeah.
Okay, I'll do that.
Dr. Emerewa, call Enyi Kano on Monday.
All right,
Request a refund.
All right, we'll share that information to the younger ones, because I don't think I can get a refund, but I was asking so that the younger ones can take advantage of it.
Enyi, he's gonna call you on Monday. In the interest of time, I gotta move on.
No, Stanley, give me one second because
go ahead.
Dr. Emerewa,
yes,
whatever your cost was, how much did you make? You
no,
didn't
but
tell
that's money that no. Wait a minute. Let's talk about that later on. Let's talk about that later on. Yeah.
Okay. Enyi, hold on. Austin is next. Austin, go ahead. We gotta keep it within an hour, guys. We gotta respect people's time. Austin, go ahead.
I would keep it very brief. I just wanted to know if the panel does reconstruction or repair of mistakes that we made in the past. In other words, can you have the availability to send your problems to this panel and let them?
I think the answer is it depends. I'll let the CPAs who are the experts in that area, but it depends. Would you agree with me, guys?
I missed the question because it was, I couldn't, it was in and out.
I think he was asking if, Enyi, I thought that you were gonna jump on this because I think he was asking about doing an analysis and seeing what mistakes was done in the past, like a repair of your financial well-being.
Well, absolutely. Those things we look back. We could look back 3 years, okay? And in looking back 3 years, you may end up. We talked about here R&D tax credits, for example. You can get R&D tax credits going back 3 years. Okay, so those kinds of things, and then we'll look at all those things, and those things inform what we do on a proactive basis. if that's helpful.
So that's the question. You can only go back 3 years. Is that correct?
Yes, if
Yes.
you're going back, yes, you can do, even in tax amendment, you can do 3 years to amend the return if there were things that were overlooked, not included, that you should have received credit, didn't receive the credit, you can amend the return up to 3 years.
Exactly.
That's a key information. You can always go, if you made a mistake in the last 3 years, you can always go back, but there is a deadline. When is the
Well,
deadline?
let me say something else.
Okay.
Let me add something else, because if you recall, Judge talked about credits. These guys are talking about credits, and some of these credits you can actually apply for up to 20 years. And by the way, if you don't know what a credit is not a deduction. A credit is a dollar for dollar reduction in your taxes. You owe $1, you save $1. A deduction, you owe $1, you save 30 cents. I hope that makes sense, guys.
Yes, okay. I want to, there's some questions on the chat. I want to go back to, somebody wants to go back to Dr. Emerowa. But before we do that, I want to, how can you save money with life insurance?
How can you save money with life insurance?
Yes.
Let me say this, guys. If you go and look at some of the major
banks, hold on. I will also say, before any say that, is all of the topics that were discussed today, we spent over an hour on most of them on ANPA's YouTube page. You can actually listen to the previous webinars on life insurance, on life settlement funds and taxes. Everything is on public on ANPA YouTube page. And you go ahead.
Yeah, and just to add to that, if you are particularly curious about any of these things, we've got and how they would apply to you. We've got a goals and objectives questionnaire, and for businesses, we've got a business best practices questionnaire. So that's it. Now, to save money on life insurance, my friends, first of all, go to bank balance sheets and see that you'll find that life insurance is actually, they own more life insurance. Most of these banks own more life insurance than they own real estate. Okay, so when you own life insurance, and if your question was about how do you save money using life insurance basically, there's a law about life insurance that where the government allows you to borrow from your life insurance policy collateral or cash value. Okay, the insurance company will loan you money and use the cash value and the death benefit, okay, as collateral. By the way, you end up with more attractive rates in those situations. There are situations where we actually are helping clients become their own bank, funding life using, you guys have look, we deal with this all the time. You have hundreds of thousands of dollars in the bank, when you can take hundreds of thousands of dollars and kill two birds with one stone. If you still want to put money in the bank, you can do that. But you can own life insurance, pull the cash from the life insurance, make all kinds of investments you want, real estate, all that stuff, okay? Buying Bitcoin and Zoom coin and all that stuff, do whatever you want. And you're still earning interest or dividends on the life insurance policy collateral. And you can pay yourself more than the bank would, more than the insurance company would charge you. I hope I'm answering your question, because I'm diving into a lot of stuff very quickly.
Yes. Now let's go back to Dr. Emerowa's question about the fees that you pay to advisors. The question, one of the question was, are those fees tax deductible? If it's, I guess if it's paid through your business, is correct?
Stanley, I'm here. Let me just explain that.
Okay, go ahead.
First of all, you can. What I've learned now is that those fees should be invoiced to me.
Exactly. That's what I was getting ready to say.
I'm coming in. Let me finish, and then you can come in. Those fees should be invoiced to me so I can see them. I can know what I'm paying for, and I can pay them from my business, a business expense. I'm not paying them from my retirement money and decreasing my retirement money. So, for instance, if you charge me $50,000 for your services, $20,000 for your services, if I give you that $20,000 and you don't take it from the $10,000 from my retirement, that $20,000 is my retirement. will stay for another 20 years. But if I gave it to you from my retirement money, you've dropped my retirement money by 20,000. So you should invoice it to me. And secondly, it makes it transparent, because you could be amazed how much the people who are advising us, yes, they are making us money, but it's not either or. It could be both. You can still make me money and I can still pay you. I'm not saying I won't pay you for your services, but I can still pay you the money, make my retirement money, and it's transparent. And if you're charging me too much, I can tell. It's like giving somebody a credit.
Okay, I think we lost Dr. Emerowa. I
Yeah,
just
the
want
point-
to
the point he's
hold on. I
making-
just want to let everybody know we are over an hour because of the sensitivity of this matter. We're going to extend it until we're done. So you can go ahead and respond to Dr. Emerowa.
Sure. So he's right about what he's talking about. Okay. One of the ways that you can actually do what he's saying is you can ask your advisors, Dr. Emerowa, you should ask your advisors to basically send you invoices in the manner that you just articulated. It is a good practice. Now, what is more typical with most of the advisory firms is those advisory fees are reduced, are taken from your investment assets. And it depends on the situation. Some advisory fees or commissions are actually tied into or locked into the investments themselves so that they're not quite as transparent. What Achoy is referring to are the actual advisory fees. You don't pay commissions on certain opportunities. For example, I'll give you an example. Companies will tell you you're going to stay in our fund for 10 years, for example, but it's not going to cost you anything upfront because they're going to get their fees from the investment returns on a net basis. Okay. Now, there are your advisory fees. You can actually ask your advisors, if you want to do this, to send you a separate invoice for that. Okay, so that you can pay for it whichever way you want, and then Charles and George can deal with it from their standpoint. Okay, so there are different areas, there are different ways, and there are different investments that allow for the different fee and commission opportunities that these things provide for. I would suggest this, that you ask those questions. We're fiduciaries, so we have to act in your best interest at all times.
Okay.
So I think you need to be talking to your advisors about these particular kinds of things that you have concerns about if you haven't been already.
Okay, I'm gonna get to other questions. I'm sorry to cut you off.
Go ahead.
There's a question about any advice on how to get tax return not received due to IRS backlog.
You're talking about the tax.
The question is there any advice on how to get tax returns not received due to IRS backlog? I guess IRS is backlog.
I have a follow-up question. What year is that tax return? Is it 2021, 2022, 2023? If it's any one of those years, then you can file them electronically. Now, you can file those returns electronically, 21, 22, 23. The other part is that if you have mailed it in already and they are backlogged, then what you could do after you send them electronically, you can call the IRS and let them know that you filed this return electronically and you also mailed a copy. And then so that they can make a notation and eliminate the copy when they do get to processing it. Otherwise, they will assume to be a duplicate return, and they may, endanger you doing an IP, what they call identity, verification to make sure that it's not a fraud. So again, you'll have to let them know that you do have a mailed copy that is in process, and they don't encourage you to file it electronically, but you want to get it in, you can file it electronically and call them and have them noted that return as a duplicate. You mailed it in.
Okay.
Thanks for the tip. I was the one who asked the question. However, the issue is I filed my taxes and they owe me money. They owe me the return. But then I have not received the return because, during COVID, they fired a bunch of IRS people. And there's still a number of people during COVID that haven't gotten their returns. I went to the office and I was like, hey, where's my money? And they're like, sorry, we'll get it to you as soon as possible. But I still haven't gotten it yet. So I'm just wondering if you have any tips about that.
You can talk to any one of two of us on the line of the record, and we will take care of that for you.
And then the IRS will also owe you interest on the money.
Interest, yeah. He's talking about refund, not return. Refund.
Exactly. It's a
sorry.
different issue. It's a different issue. And again, the refund depends on the amount of refund, depends on what is claimed on the return. They're probably investigating, reviewing the return. And that is why the refund hasn't been issued. Now, if they're investigating or reviewing it, depending on who they assign it to, they may have a backlog on their desk and they have to look at it. And again, they assign them based on expertise. The subject matter expert on that area will have to take that issue, review it, and see if the return or the refund is appropriate. So again, what you need is check a tax practitioner to look into it for you and zero in where the return is and find out why it's being held. And otherwise, they will take their normal time to process it, and it may take 6 months, 8 months, 9 months. And again, sometimes it might take a year.
Okay, thank you very much, Charles. So the next question is to the group. Can one use prepaid taxes to pay for personal tax preparation as well? Second question, do you always need to use your business?
Let me say that.
I can start on the business. Do you always have to start on business? Can I start on that?
Yes, please.
Go ahead.
Number one, if you're a C corporation or S corporation and you lease a vehicle in the name of your company, you can deduct the entirety of that lease amount. Not because they are business-owned vehicle driven by an officer of that corporation. Now, if you're a sole proprietor individual and then you buy a vehicle, can you deduct that same vehicle the way you would deduct it as a business? The answer is no, because it's not listed in the name of the business. Then the worst case scenario, if you use the vehicle to run around to do your hospital runs or to run from one office to another other than regular commuting, then you are not going to get credit for it other than the mileage. So there is a difference on how you structure a business and how your expenses are also structured.
Thank you, Charles. Enyi, do you want to add to that?
Yeah, real quickly, what I was going to say, and he just talked about something really interesting, or really important. In the next couple of weeks, I believe, and Cliff confirmed this, we're looking to give a presentation on management services organizations and kind of pivoting to C Corps and things like that as a tax strategy. Okay. What can a properly structured MSO do for you? Asset protection, income protection, tax reduction, all of those things. And a lot of guys and gals, forgive me, don't know what all this means. We have an expert that will hopefully be delivering this in another of our communities, and maybe we'll come back here in 2-3 months and kind of talk about this also. But this is something that's coming up in the next few weeks here under Cliff's wingspan.
Okay.
Okay.
Austin, your hand's raised. Go ahead.
Yes, thank you very much. As you see the trend in medical practice now that a lot of our physicians are getting employed by hospitals. So you're on a W-2 program. And you did tell us that it's best to own. So let's take a scenario where an employed physician who's already on receiving a W-2, 35% tax bracket. And he goes to try to open a corporation or an LLC, how do you use the taxes that have been withdrawn by the facility and make some gains from that when you file your taxes using your corporation?
Any of you want to answer it, Docs? I mean,
Judge,
guys
Judge,
on the team.
I think.
Okay, Judge is left.
So
who
we see
left?
Charles.
If,
Charles,
I
can you take
can
that,
I
Charles?
can take it. If George is not taking it, I can take the question.
Okay.
Sure.
How do you use, take for example, if you do a locum and then you do have a company and it's an S corporation. And then with the S corporation, you do have expenses. You loaded the expenses on the S corporation. So for example, the locum makes you about $80,000. Your S corporation makes you about $160,000 in expenses. Those 80,000 negative flows through to your personal tax return, to your personal tax return via K1. And then you get that personal tax return, then that income that your employer paid you as a W-2 is reduced by $80,000. And that $80,000 now lowers your tax liability and your tax bracket. So you basically save on that money that you paid through your W-2.
I hope this is clear. I hope this is resonating, guys. This is extremely important because this is where proactive planning comes in. Okay, because you can, this is what we talk about, work to own. Work, get your W-2 to own a business, whichever way you get it done, because that's how you can funnel back these savings into, I mean, your expenses into savings, and then take the savings and then grow them. You can grow them tax-free, taxable, and all that stuff. That's the point, guys. Work to own on a, go ahead.
What is the secret sauce here? Is it to be employed or to own your own business somehow?
To buy a Tabasco sauce.
Huh?
To buy a Tabasco sauce.
The secret sauce is the
Can I say that
the secret sauce is the business.
business.
He's completely correct. The Tabasco sauce is the business.
Okay. All right.
Own a business. You got to own a. Look, America, the greatest gift America has given to its citizens is the gift of owning a business.
And then the
And
question,
also to add to what Mr. Hayes said is owning to a business. Look at it. Have you ever asked yourself questions like, why do they tax you as an individual at 35%? Prior to Trump in 2018, the Trump tax, it was 37%. So he drops to 35%. And then prior to that, it was 39% individual. Now, prior to that, the corporate tax return was at 21%, raised to 25%. Why are you paying almost double what a corporation is paying? And they are the one making big money because they want you to so-called employ people. And when you employ people or you spend money, that is where you make money. So you don't deduct mostly on individual. And even if you deduct on individual, the tax bracket is higher compared to a corporation. So basically, they are, Mr. say, go to a corporation, form a company.
Okay, I'm going to the, we're going to be ending in about 2 minutes. I have 2 questions, and then I'm going to open it up for anybody else to do a final. When is it better to file for single versus joint filing?
That is the wrong question, because if you're single, that means you're not double. Meaning you don't have a wife. So that's the wrong question. If maybe your question could have been, when is it best to file married filing separate or married filing jointly?
Okay, can you answer that? Answer that. Answer the correct question.
Okay.
So, Stanley, can you put up how to reach us, please?
Yes.
I'm sorry.
No, I'm just responding to. Go ahead and answer the question.
Okay, is it better to file married filing separate or married filing jointly? This is my advice to my clients. If you're married, the best way to file is married filing jointly. Now, if you have issues like the husband or the wife has issues, family, where they owe liabilities, and then where there are liabilities in place with the other spouse before you met the other spouse, and then you don't want to carry that load of being stuck with their tax liability, with their levy, with their lien, with all of those things going on them, then it is important you file married, filing separate. But remember, the married filing separate in the tax world, we call it the death penalty. Why is it a death penalty? It denies you the ability to get credits that you would have gotten on your children if you have children, because those are excluded. And in that case, because they're excluded, you have a possibility of paying a higher taxes on when you file married filing separate than filing married filing jointly. So my advice, unless there are issues that cannot be resolved, IRS has two things. They call it innocent spouse and injured spouse. Innocent spouse and injured spouse. Now, this is where your refund was seized because your spouse owes before they met you, or there's issues where your spouse has an issue with you filing a return without them knowing about the consequences, and then now you are stuck in it. So those are the things where you file either innocent spouse or injured spouse. But nonetheless, to escape those issues and not be part of it, or dragged into it by marrying a wife that you love, then you file married filing separate. But again, you lose credits if you have children. I don't know if I addressed your question.
Yes, I think you did. Thank you very much, George. Austin, go ahead and ask your last question, Austin.
Oh no, my hand is down. They
Okay,
already answered.
wonderful.
Let me say something. One thing I talked about when I introduced Charles was I mentioned something, and I said I have teased him that I will be getting a key person policy on him. Okay, hopefully in the Q&A, he has given you the reason why I said I'm getting a key person policy on him, so that if anything happens to him, I collect, by the way. So, okay. Anyway, listen, we are here for you. You can basically go to our website info, this is Kanoa said, I don't know, my brain is a little fogged right now, my friends. You can see it on there. I think we've kind of done this enough times where you can reach us one way or the other.
Yes. So, Eni, I really want to thank you for giving us access to this subject matter experts, so the ANPA members can really educate themselves and make important financial decisions. And I want to thank both ANPA and ANPA Foundation for making this available to us. The ANPA webinar, financial webinar, will be hosted quarterly at 12 noon. Today we went over 20 minutes because it was so much information. And I'm trying my best to kind of manage the time, but it is going to be the best and the highest use of your time. For launch hour, those in the East Coast, is free to ANPA members. This webinar is being recorded and it will be posted on the ANPA YouTube page sometime today. We'll also send a link to all the ANPA WhatsApp pages and email links, so you'll get it. And I think that's all I have. Is Cliff still here? Let me call him out. Cliff,
Of course, I'm here. I'm always here.
Can you
Thank
give
you.
us a final closure comments? You're the only ESCO man here.
Well, you put me on spot, but I'll speak.
I
So
know.
I want to thank our presenters.
Stanley, Chris is here now. He's not the only ESCO man. Chris is here, so please be careful.
Okay, Chris, go ahead, please. He's my senior.
Okay, Chris, our immediate past president, please say something.
No, we'll allow Cliff. Cliff is the incoming president, so let's give him that benefit so that he can start to learn fast.
Look, man, I love ping pong.
All right. Thank you, everyone. Eni, thank you and your team for wonderful presentation. Tax is something the less you pay, I think nobody wants to pay more tax, according to President Trump, you know? So this is valuable, not just tax, also ways for us to save money for future generation, as well as do something good through our philanthropic contributions. So thank you, Stanley, for again putting this together quarterly.
You know,
and somebody's calling Gabby. Gabby, answer them, please. And then we look forward to our next ones, please. And let me chime in now to say I want to see all of you in Anaheim. June 19th to 22nd is our ANPA convention. And thank you again for all you do.
Thank you, Cliff. I also want to recognize all of the ESCO members here. Dr. Goethe Anyowoke is here. I'm so sorry for Dr. Chris Okunse. I didn't see him. Is there anybody else I'm missing? I want to maintain all the protocols. I don't want to get in trouble. I want to go to California and come back. Dr. Goethe, please.
Thank you, Dr. Okoro, and thank you all our financial experts. These are very, very well needed information. And I would say Mr. Charles Wapara is my personal accountant, just for those people that don't know. I was surprised to see that he was here. So thank you so much, Dede, for coming here. And of course, our financial guru, Mr. Kano. Thank you all. Thank you.
All right.
Thank you.
With that,
Thank you very much.
End recording. Thank you very much. The next one will be next quarter, Amy, and dates to be posted soon. Everyone have a wonderful weekend and talk to you guys soon.